Good afternoon, or actually a late morning to folks out there. I'm Don Chimay. I'm serving on the program chair this year for the Atlanta Association of Health Underwriters, and we wanted to welcome you to actually the final session of the Virtual Benefits Forum. So I think we've had a great couple of days. We had a lot of great content, and we really appreciate your attendance. Before I introduce our speakers, I just want to let you know that this session is being sponsored by Kaiser and by ClearTracker, and we certainly thank all of our sponsors that have stepped up to the plate for the forum. You guys, if you have a chance, even after this last session, the virtual booths will be open. I know a lot of folks have posted a lot of files for you to kind of look at, see kind of how their business can help you. Some of them have videos out there that can help you. And certainly, if you get a chance, drop in there and see what they can do to help your business. So I, with a great amount of pleasure, want to introduce our next session, Help Your Clients Afford the Life Insurance They Need. We're going to have a discussion around premium financing, a little bit of a different kind of discussion for the health underwriters focus probably, but I think everybody out there understands the value in a life insurance program. So this is kind of a unique way to help some folks buy the insurance and give you some insight around how to do that. The first individual I'm going to introduce is Todd Schoonover. Todd is the Regional Managing Director for the Principal PAN, we call them PAN offices, the Principal Advisor Network here in Georgia. And he's being joined today by John Skaman. John is the Senior Financial Services Manager with Global Financial Distributors. More formally, I have a coworker that's right here that is going to get ready to jump in my lap. So, so hang on. As I said, Todd is the Regional Managing Director at Principal Advisor Network in Georgia and Alabama, where he oversees the growth and development of the Southeast Business Center. With over 2 decades of experience and knowledge in the diverse world of financial services, Todd leads and cultivates financial services professionals' practices for the ever-changing, dynamic, and fast-paced investment and risk management environment. He is joined today by John Skaman, Senior Financial Services Manager at Global Financial Distributors. With more than 32 years of experience in the banking and financial service industries, John brings extensive firsthand knowledge and case experience to his role. Prior to joining GFD's parent company, Enter Global, in 2005, John worked as an independent registered investment advisor for 4 years with clients throughout the state of Georgia. He worked from 1995 to 2001 with Citigroup as a financial services advisor. Prior to that, he worked with Bank of America in California, beginning his banking career in 1988. John's experience and Todd's experience, I think, are going to be something really exciting to hear from. It's kind of, like I said, a little bit of a unique presentation. But gentlemen, we appreciate you and look forward to hearing from you.
Don, thank you so much. And I'm going to see if I can get this share screen thing correct. And let's see. Can you see the screen now, Don?
Yeah, there it is. Yep.
And you can hear me okay. So everyone, thank you so much for allowing us to speak today for a little bit. So besides it being my first time speaking at the AAHU and the GAHU, it is Life Insurance Awareness Month in September. When Don and I talked about this topic, I was like, oh, this will be perfect because all the benefit advisors and benefit agents on this call have life insurance license and can do this if they want to with their trusted relationship. So the goal for today's meeting or this session is a couple of things. One, to introduce you to the concept if you're not familiar with premium financing and how that works with clients and specifically business owners. And to set the backstage a little bit, premium financing has been around for a long, long time, or at least the thought process. And what do I mean by the thought process? So I wrote down some things. Here's what clients are asking. Here's what your business owner clients are asking. How can I or my business own a bunch of insurance, life insurance, or insurance in general, but specifically with this concept, life insurance for a key person, succession planning, retention program that's put in place. And on the flip side, pay as little as possible for that themselves, or have their company pay as little as possible for that. Or even a better idea or strategy is, could someone else pay for it? And so there's a lot of misconceptions on what premium financing is and what it is not. As we ask those questions, your clients, your business clients, are still asking those questions today. So there are 3 or 4 components in a premium financing discussion. That's why I've asked, Principal or a life insurance company or a financial planning company. We do group benefits, investments, 401ks, etc. I also asked one of our lenders that we use, not that I'm endorsing anyone, and nor are we being endorsed, John Skeman with Global Financial Distributors, which is an affiliation of Synovus, to talk about some things. But here are the 3 or 4 components that need to take place. One, there needs to be a client or a business situation. And there's a certain criteria. Not every business will qualify. Not every client will qualify. There needs to be a revenue stream and a net worth involved there. You as the advisor, you as the benefit agent, you're the one that has the trusted relationship with your client. You need to pick an insurance company. There's an insurance provider, and then the last one is a lender. And so I'm going to turn it over now to John, and let's see if I can get this to work the way it's supposed to. Hold on 1 second. There we go. So we talked about this. I do want to, before we get to John, this is the concept. Premium finance is a unique way to pay for life insurance premiums for high net worth individuals and business owners. Many high net worth individuals die without fully utilizing their insurance capacity. What do I mean by that? They can get a lot of insurance, but they oftentimes don't do it because the high premiums that are involved, gifting limitations, and other factors. So John's going to talk about the understanding of life insurance premiums. I'm going to social distance 6 feet away back in this chair. John, thank you so much.
Thank you, sir. I appreciate it. I think our picture screen, you know where I am because we lost our...
Yeah, let me see if I can find that.
Right over there, maybe?
You guys look pretty good.
If it's
okay,
gone,
yeah, it's gone. Don made it.
It's down there. It's down there somewhere. All right, there we go. Oh, can you drag that right there?
I can.
Perfect. There we go. Now I can still see myself and see what I'm presenting. Thank you.
And there's that right there.
Got it. Thank you. Appreciate the opportunity to be here. My name is John Skeman. I work with a company called Global Financial Distributors. I work with agents and carriers and provide premium finance. So typically somebody's going to come to me and say, hey, this is what I want to sell my client. Can you finance it? What would that look like? And I put some numbers together. Todd brought up a very interesting fact. When I was in the field back in the day, I would talk about where somebody was trying to get to and the things that they might need to do to get there. And if they were on track for retirement, we might say, well, you need to get a better rate of return on your investment because you're kind of lagging behind, or you might want to invest more money to catch up, or you need a lump sum at a certain interest rate to reach your goal because nobody's going to finance your retirement for you. Well, that's changed. As Todd mentioned, premium finance has been around for a while, but a lot of us didn't understand it, know it, how it works. Our company that's been around for more than 20 years now recently merged with Synovus Bank to specifically market premium finance. That's the only thing my division does. So I'm not going to talk about our program. I'm going to talk generically about premium finance. As benefit advisors, you might be talking to a business owner about their need for key man, buy, sell. I'm actually I have a little PowerPoint here. Click. There we go, life insurance premium finance. So we talk about these areas: business succession, retirement planning, key person. These insurance policies, when I've met with clients before, I met a guy in Cuba on a cruise ship and had this business, and he talked about brokering vehicles, and that he makes all of this money, and that he has a partner, but that he didn't have any key man policy in place. So that if he were to die, his wife would now be in business with his business partner, and they needed something to take care of that. And I said, well, did you look at it? He goes, yeah, it was very expensive. And I said, well, if somebody else could pay for it, would that interest you? And his wife was sitting there going, I'm sorry, excuse me, somebody else pay for it? So we started talking about premium finance and the way that we could lend money to his business, have his business borrow money and use that money to buy the life insurance, but have him personally own it outside of his corporation as a personal asset that cannot be attainable through lawsuits. So again, we're looking at large premium dollars to purchase these life insurance policies. So if the premium is over $100,000, you should talk to somebody about financing it. Because if you could borrow money and you say 4% on $100,000 is $4,000. If you could sell somebody a huge life insurance policy, lend them $100,000 to buy it, pay $4,000, maybe even take a tax deduction for that $4,000 because it's a commercial business expense. So now the $4,000 maybe cost you $3,000, but you have $100,000 in a life insurance policy with a huge death benefit that, God forbid you die, I get repaid and your beneficiaries get the rest. But if you live, which is the plan, every time we put money in there and that cash value grows, you get to use that cash value for future benefit and retirement, income tax-free distributions from a policy. Again, if you set it up right and you do it right, you're going to avoid those taxes, and you're going to have all of that money that grew tax-free for tax-free distribution in the future. So what is it? Loans are used to fund life insurance needs for an individual or a business. I can do it's not a commercial loan. I can do a personal loan through a trust, which would require a personal guarantee. If I lend to a business, that becomes a commercial loan with no personal guarantee. And because it's a business expense, they can probably, if we talk to their CPA, take a tax deduction for the interest on that commercial loan. There's mention of an arbitrage in here. It's not the reason we sell it, but it does work pretty well, that if I charged you 4% and you were in an IUL earning, 6 or 7, let's take a look at a whole life product. I could charge you 5% interest. You might earn, and now let's use whole life. You got a 4% guarantee on whole life. So you're guaranteed to get 4%, but with dividends, it could be higher. So guaranteed 4%. If I charge you 4% interest, that's a wash. The beauty is that you have life insurance, and we haven't even talked about taking a deduction. So if you took a tax deduction, 4 might cost you 3. So there is a little arbitrage there, but the benefit and the true analysis here, you're looking at the fact that if your premium was $100,000 and I only charged you $4,000, what did you as the advisor do with the other $96,000 that they kept in their pocket? You got other benefits for them, other options for them, other investments for them to grow that money, because they can keep that money in their pocket because they now don't have to use it to pay the premium, because we are going to pay that premium for them. Now, what it is not, what premium finance is not, it's not the arbitrage. I mean, you might get an arbitrage. Again, IUL at 6%, loan at 4%, there's going to be an arbitrage there. It's not free insurance. There's still a cost. We as a bank are going to look at the policy run at 0% or minimum crediting. We want to see worst case scenario, what we're going to be holding as collateral against the loan. It's not a simple transaction, but I always say, look, go back to selling the insurance, look at the insurance needs, solve for the insurance problem. At the end of the day, if that problem costs more than $100,000 a year in premium, call me and let's talk about financing it. It's not a risk-free transaction. The market goes up, the market goes down. We've seen that. I will say that rates right now, I've got LIBOR floor of 75 and I've got rates as low as 180. So you're looking at 255, 245 to borrow money. And we're talking about millions of dollars at that kind of a rate is phenomenal. and an option suitable for every client, meaning that this is not, and Todd mentioned that, this is not for every client, but we're happy to look at every client. Again, there's net worth requirements for different carriers, so we do need to structure it properly and make sure that we follow the carrier guidelines. So just a snapshot, again, people that you're talking to, LLC, S Corp, C Corp, partnerships, typically a smaller type company, not necessarily, and I will say publicly traded companies can't do this. So this is all privately held, smaller businesses, could be used for key man. It says typical age 40 to 60. That's because somebody at 35 might not be thinking about retirement yet, might not be thinking about shoving extra money away yet. Somebody at 60, that's great, but we know that insurance costs at 60 start to rise. And if I start a program for somebody at 60 and I fund it to age 70, it took me 10 years to get the money out in there. It hasn't had any opportunity to grow, and you really don't want to start pulling it out at 71. But the cost of insurance is going to start eating at that cash value. So that's why we say, you know, you'd like to see it between 40 and 60. I'd love to see people start earlier, but somebody who's younger is still going to need to qualify for that death benefit. When you're trying to buy a $5 million, a $10 million, a $20 million life insurance policy, the client still has to qualify. So somebody's 25 years old and looking for a $40 million policy, hopefully they invented something that's paying them lots of money, which is why they can justify that need for that death benefit. So again, we're going to be following the carrier's guidelines. Typically my guidelines are, you know, income over 250, a net worth greater than $1 million. I've got some carriers that want $2.5 million, $3 million, $5 million, and $10 million. So we're going to talk about, you know, what you're selling and what that carrier requires. I had somebody with an illustration the other day. They were so excited and talking, you know, this is awesome, this is awesome, this is awesome. And then when we found out their client's net worth, I said that carrier is not going to accept that client. So that's where my expertise comes into play in helping you to make sure that you've got the right carrier lined up with the right client. So, you know, why, again, does somebody want to do this? Because, again, you can use somebody else's money to make money, and we know that that's how the rich get richer, right? Cost effectiveness, retention of capital, tax efficiency. I mentioned the tax deduction, but I am not a CPA, so we need to talk to the accountant about that. And that it helps to optimize cash flow. Now, the participants mentioned, you've got the lender, that's Global Financial Distributors. G1 is actually the bank that's writing the check. We're both a subsidiary of Synovus Bank. You've got the policy owner and the insured. Typically, that's one and the same with the business owner. So a business is borrowing the money. The president, CEO, is probably the insured and the owner of the policy, so that asset will be outside of the corporation and not attainable in a potential lawsuit. So you've got some asset protection here that we can go into more detail if you like, but again, I just want to give the 50-foot overview. Our clock over here stopped, so I don't know where we are on time, but I think we're humming along. Primary components. You've got a commercial loan. Thank you. You've got a commercial loan. That's where the business enters into an arrangement with Global Financial. We set up a loan. We lend that money to the business entity, and then that business entity enters into an agreement with a participant. So if I lent $1 million to the business, how do we get it from the business to the individual? From the personal pocket to the, or sorry, from the business pocket to the personal pocket. I mean, we know it's the same pair of pants. We know they are one and the same, but how do we tax efficiently move that money? And again, conversation with the CPA, but we have a third-party admin kit or a plan admin that talks about different ways of recording the transaction. The first would be you could do a distribution of basis. Most of these companies aren't going to have basis. If they do, you could do a distribution of basis. Again, most don't. You could lend the money. I can lend the money to the company. If it's an LLC, I could do the 752-731, which says if I lend money to the company puts it in a life insurance policy and pledges that life insurance policy as collateral for the loan. They have just done an increase in their basis. And if you step the basis up, you can do a distribution of basis without any taxable event. So again, structure, talking to the CPA about how to set this up properly. The majority of our loans are set up as a back-to-back loan, 78-72, split dollar. I lend money to the company lends it to the employee. So the employee is going to report economic benefit of a back-to-back loan. So if you were going to lend money to yourself, what would you charge yourself? And the answer is 0 because you like yourself. But the government doesn't like you as much, so they require you to pay your company something to borrow your own money. So again, we go through all of this. It is outlined in the plan admin. The math for the calculation on that is in the plan admin, so that mitigates your risk, the client's risk, even the CPA's risk, because the client can provide that plan administration package to the CPA. The CPA can transfer those numbers in about 15 minutes and move right on with the tax return. So if that's how it's done, then that money, which is transferred, either bonused, that's the other one I didn't mention, a bonus, which is a 162. So you could pay, if I lent the company $1 million and you bonused yourself $1 million, you'd have tax on $1 million. I'm not going to lend you $1 million first year. I'm going to do, say, $100,000 a year for 10 years. So the first year's bonus would be 100, and you would pay tax on that if that's how your CPA chose to do it. So how that's transferred is, again, discussed with the CPA and make sure that everybody's on the same page before we even go to closing. And then once the loan is established and the policy is issued, we will send money directly to the carrier who will then fund that contract. That contract will be held in our vault as collateral to secure the loan. And then in the end, you either pull the money out of the policy to pay us back, sell your business and pay us back, or knock on wood, God forbid you die, the policy will pay us back and your beneficiaries will get the rest. So I want to try and show you a quick case study, and I don't want to go into too deep of a detail. Again, there's going to be a lot of numbers here. It's my understanding that this is recorded. I also have some recordings myself of this presentation. If you're interested, let us know, and we'll get it out to you. But I've got an IT security consulting company here. So I'm going to get some water. Sam Williams, business owner, makes about $5 million a year, annual income about $500,000. He needs some life insurance, supplemental income. He's got a budget of about $95,000 to work with. And so what we looked at is, all right, let's look at a universal life policy, indexed UL. Annual premium, $357,000, premiums for 7 years. He's going to take out a loan of $2.5 million. His cost overall, including the recognition of the premium that was given to him from his company, his initial death benefit almost $12 million. He began distributions at age 65 to 95, and he's going to have distributions of $300,000 a year. And at age 95, he will still have a death benefit in that policy of almost $3.5 million. So we've actually put the numbers together to show you how it looks. We show the repayment of the loan coming out of the policy. We show the income starting at, I got to look at the blown up, looks like 67, he started that income, or no, 65, he started that income at 301. So these numbers on this spreadsheet are basically our interest rates, but we pulled the surrender values and the death benefit from the actual contract and input them into the spreadsheet. So agent comes to me and says, hey, this is what I want to finance. I take the numbers from the illustration and create an illustrator like this that you see and show you the actual numbers and the cost for the loan. Potential risks, just want to point this out, whoever you use as a lender, watch what they're proposing. I can tell you some of the things I've seen. The biggest thing is a lot of people will get something like I just showed you. Let me see if I can go back. So somebody will get something like this, but they won't have the supporting documentation behind it, like the actual illustration. So when people send me things like this and they say, hey, can you do this? Can you beat this? Have you seen anything like this? I always ask, where's the supporting documentation? Where did these numbers come from? Where is the life insurance illustration? And a couple of them that I've seen say right on the front page, the information behind page 1 is worthless unless it's supported by an illustration, and then they don't provide them the illustration. That to me means that all of the numbers in their spreadsheet is made up. So be very careful with that. So what I want to look at the risks is stress test the interest rate. I like to see the interest rate rise. You know, I want to show a client worst case scenario. If the interest rates start going up, this is what it's going to look like. But also understand that the crediting rate of the life insurance policy is probably going to increase as well. So we want to look at what the options are, look at the different rates, swaps or caps. Policy performance, again, you want to go in and adjust the return. I think the new AG 49 is going to help us with that, because we obviously aren't going to be able to illustrate like we used to, and there's a whole bunch of new rules. I'm not even going to go into all that. You all know this is continuing ed, so get some continuing ed on the new AG 49. Collateral requirements, illustrations using a wide carrier range. Again, different carriers are going to have different riders that are going to provide different cash surrender values. So when you're doing a comparison, I always say, when people ask my advice, I say, well, what are you comfortable selling? What could you sell with your eyes closed? What bells and whistles do you understand about each product? Your death benefits are going to be relatively close. Your premiums are probably going to be relatively close, but your cash surrender values are going to be gravely different. And if you add a rider that increases cash surrender value, meaning that I would need less collateral from the client, because if I lend you $100,000 and there's 85 in the policy, I need another 15,000 in cash, letter of credit, another policy, or a brokerage account with a minimum of 250 in it. So you want to look at the different riders that these policies covers. Here's a balanced cash sheet benefit rider. So there's a rider you can put on the product that increases that cash surrender value, but the cost of that rider will affect the cash value in the long run. So again, we want to look at all of the options. We want to look at the different carriers. Carrier risk, credit reporting agencies. Basically what we're saying here is we only use A-rated carriers. I think it was a few years back, F&G was losing their rating, and so we had to shift the portfolio. If you had F&G product, we either moved you to another product, or if you wanted to pay off the loan, you could, or if you wanted to keep that product, we could, but they were going to add a premium to your interest rate because that carrier was no longer A-rated. So we're always looking at making sure that we're putting money somewhere safe and secure that we can always get it back. Lender renewal risk, this is huge. Our program is specific and the only one in the industry that I'm aware of where I'm going to underwrite you today for a loan, for the entire loan, not just the first year's premium or second. I'm going to underwrite you for the entire loan. I'm going to give you that loan today or approve you for that loan today. I'm going to fund over the next 7 or 10 years. And at the end of 10 years, your loan automatically renews for a second 10-year period with no underwriting, no fee, and nothing else. All your rate's going to stay the same. Your spread's going to stay the same. I'm going to basically underwrite you. We call it one and done for 20 years. I don't need tax returns every year. I don't need to underwrite you every year. These other loan companies that are out there are offering a 1 year, a 2 year, maybe a 3 year, but they're not guaranteed. They're going to give you a 3-year loan, and in year 2, they realize they can make more money lending to buy cars, and they're going to call your note. Now, we actually have a program called bailout or rescue. If you run into that situation, or you know anybody that's got premium finance, or their rates are too high, or they have, I've got one right now that's got a $700,000 loan against the cash value. I can put that $700,000 back in, get that policy cranking again. I can lend him the $700,000 for less, and he can take a tax deduction, and his policy can be at full bore. So take a look at your book of business. Happy to talk to you. Reach out to Todd. Let us know how we can help. Ensure the borrower stability through program design. Look at worst case scenario, including collateral. That's what I was talking about earlier under collateral requirements. So these are some of the issues that are out there that we're aware of, that we try to point out when we're doing a comparison of some sort of apples to other lenders that you might be looking at. So with that said, information is on the screen. I think I'm done. We're going to be passing back to Todd to do some Q&A, and I'll step out, sir.
Thank you, John. Appreciate it. So It gives us a really good overview of some of the options that we have or that you have with your clients in coming up with some alternative strategies to help them reach their goals. And when I was listening to John, I was thinking of this. At the end of the day, clients and advisors, agents all have the same questions. How do we holistically cover many pieces of their puzzle? And most clients don't have unlimited funds. Most businesses don't have unlimited funds, so they have to make choices. If this gives you another arrow that you can take to your client and say, listen, I know you need, and you already have in place these insurance strategies, and you've had to substitute and maybe not have the dental insurance that you wanted to have, or the accidental death and dismemberment, or whatever's on all those different things that you can add on the group benefit side. This could be a viable option. This could be a viable option for those individuals that you have. Opening up right now, I just said thank you for letting us present. Here's my contact information as well. Like I said, John said there's many carriers, many insurance companies. John's organization is one lending firm. You may have lending relationships yourself, and that's all great. So I think we are right on schedule. Don Chimay, let me see if I can figure out how to stop sharing this. Stop sharing. Can you see me, Don?
Yeah, I can. So thanks, gentlemen. That was very insightful. We really appreciate the time. Can you hear me okay?
Yes, I wanted to make sure if there was any questions in the chat. I haven't looked at that. I've been paying attention to the presentation. Also, I know that we had some sponsors that maybe weren't on the front side. I wanted to leave them some time on the back side. So if we want to go through some of the chat for Q&A, it's...
Yeah, so if anybody has any questions, please, let's use the chat feature, maybe give it a minute or so, see if we have any questions that come in. In the meantime, I actually have a question because I'm just
certainly go ahead
that maybe you and John can address. So what do these loans typically look like in the sense, are these, talk a little bit about how the life insurance, sometimes on these policies you're paying, in your illustration for 7 years, for 10 years, for 20 years. I think it all depends on the product, right?
Mm-hmm. Yes.
What does the loan look like? Is it tied directly to the term in the policy, or is it a variable loan? Is it maybe just a little more insight into what those loans look like?
Okay, so I'm going to talk about that, but I'm also going to talk about what insurances you can and can't use, or what lenders will not look at. So term insurance is off the table because it has no cash value. The second portion, the second part of the type of product, then I'll get to the loan component, is the risk. So variable universal life is not an option for, John can come up and talk about this as well. We can stand side by side. It is not an option for that. So typically the insurance contracts themselves, or that of a whole life or a index universal life. So there has to be some return there and some guarantees, some security. The structures of the loan, it depends on what the loan is for. So if we're using it for, in this context, we were talking about for business owners and business strategies. You can also use premium financing for estate planning purposes, and then therefore would go through a trust. So John, if you want to touch a little bit about the types of loans, or we'd have to go back and then share the screen.
Yeah. I'm gonna bring this back up, and we'll share the screen again and go into a little detail for you.
Is it that one?
Yep. There we go.
Tell me if you see it. Oh, I gotta hit share.
Right screen. Ta-da! There you go.
Can you see what we're looking at?
There it is. Yeah.
Okay. So this is the page that I was skipping earlier, because it does go into some detail. And in this particular instance, I'm looking at the fact that, and you can run across the numbers here. I don't know if you guys are seeing it big enough, but I mentioned an example of funding $357,143 a year. So this spreadsheet shows, here's your $357,143 for 7 years. Yeah, that can be 7 years, that can be 10 years. Obviously, a 10-year funding would make a policy stronger than a 7-pay, but you're borrowing more money. But then means you just got more money working for you. That's all. I ran one the other day, and it was something incredible because it was 19 million, I think, whatever it was. His cost to me by the time it was fully funded was close to $400,000 a year. But if you looked at the cash surrender value growth on the far side over there, his cash surrender value was growing by $700,000 a year, and he was paying me $4. And that's even before a deduction. So if his $4 really only cost him $3, and this thing was growing at $700,000 a year, how long would you keep that kind of long? I mean, I'll take that money all day long. So structure-wise, stress testing this policy, you can see we were at 4.52%. They ran that for 5 years, then they increased it 50 bips for 5 years, then they increased it 50 bips. That's kind of stress testing it. The other way I would do it is I would increase that from, say, 452 to 462 to 472. I might show a 10 bip increment every year just to show some stress testing. You can see the gross interest payment on 357. So I lend him 357. He's paying me $16,000 a year. If he took a tax deduction, it'd cost him about 10. So this is the structure. Every year I fund, then his payment goes up. Next year it's 32, then it's 49, then it's 64. You can see the cumulative loan balance increase. You can see the payoff. You can see the policy surrender value and how it increases. And in the first year, he's got a shortfall of about $75,000. So I need additional collateral. In the next year, again, assuming I'm going to look at 0 rates of return for the first 3 years, and then I'm going to assume current crediting. So for the first 3 years, I want to assume it gets 0 or 1% or whatever the minimum is with current cost of insurance to determine what the collateral shortfall is. That's the additional collateral we'll need. As the policy starts to grow, we'll start releasing that collateral if it's cash. If it's a letter of credit, we'll tear it up as soon as it, runs out. But again, depending on the carrier, depending on the product, you might see that crossover in year 3. You might see that crossover in year 7. If you're using whole life, you might not see that crossover until year 9 or 10, yep. Again, depending on the product. So what is your client looking for? What are their concerns? What are you comfortable selling? I'm going to finance it all. Just bring it to me. Give me the opportunity to finance it. Does that answer the question about structure for you?
I think so. It's a lot of different types of solutions, I guess, depending obviously on where the need is, right? I mean, that's all you're building around is that need and how long these policies are going to be.
Well, another thing too, Don, is you're looking at interest rates are incredibly low right now. And we don't suspect, or no one suspects they'll continue to be this low. In this example, we're already stress testing and are looking at something right off the bat that is a little bit higher. So being even more conservative for your client.
Thank you. Does not appear that we have any additional questions. I don't know if it looks any different to you guys, but so if there are none, with that, gentlemen, thank you very much.
Did your sponsors come on, Don?
No, I didn't see them. So again, just to for those of you that are on the webinar, this session was going to be sponsored by Kaiser and by Clear Tracker. So, as we've talked about a lot throughout the last couple of days, please go ahead and visit their booths. We really appreciate their help putting this together. Gentlemen, thank you for your time. We appreciate the insight. And again, everybody on the line, thank you for attending the virtual benefits forum. I know several of you are also rolling into the Medicare Summit. So enjoy that next day and a half that the GAHU is offering that. There's some good CE that's a part of that program as well. So again, thanks everybody. Have a very good afternoon. Talk to you.
Thank you so much, Don. Appreciate it. Bye.